The IRS just made 5 quiet changes for 2026 that most retirees have not even heard about yet, and at least one of them could either save you thousands of dollars or quietly push you into a higher tax bracket without you realizing it until your return is already filed. Rule number 1 involves your standard deduction, and this is the foundation everything else builds on. For 2026, the standard deduction jumped to $16,100 if you file single, and $32,200 if you are married filing jointly. But here is the part most people miss. If you are 65 or older, you get an extra amount on top of that. For 2026, that additional senior deduction rose to $2,050 for single filers and $1,650 per spouse for married couples. Stack those together, and a single retiree over 65 is looking at more than $18,000 in standard deduction alone before a single dollar of income is taxed. For a married couple where both spouses are over 65, the combined standard deduction and senior add-ons push past $35,000 before any other planning is even considered. Most people file the same way they did 5 years ago and leave this extra cushion sitting on the table. Rule number 2 is brand new, and it did not exist before 2025. The IRS introduced a special bonus deduction just for seniors worth up to $6,000 per person if you are 65 or older. This is on top of the regular standard deduction and the extra senior deduction from Rule 1. So a retired couple where both spouses are over 65 could potentially add $12,000 in bonus deductions to their return, on top of the $35,000 from Rule 1. That is real money that simply was not available to retirees a few years ago. But there is a catch that catches people off guard. This bonus deduction starts phasing out once your modified adjusted gross income crosses $75,000 for a single filer, and it disappears completely above certain thresholds. It is also temporary, currently scheduled to run through 2028, which means the window to take advantage of it is shorter than most people think. Before we get to rule number 3, if you are finding this useful, hit subscribe now, because rule number 5 is the one that almost nobody is talking about. And it could be the difference between retiring comfortably and running out of money sooner than planned. Rule number 3 is about required minimum distributions, and this one is sneaky because the headline rule did not change, but the math behind it did. The age at which you must start taking RMDs is still 73 for anyone born between 1951 and 1959, with that age rising to 75 for people born in 1960 or later. What changed for 2026 is that the IRS updated the life expectancy tables and worksheets used to calculate exactly how much you are required to pull out of your traditional IRA or 401k each year. Even if your account balance stayed exactly the same as last year, the dollar amount the IRS expects you to withdraw can shift slightly because the divisor used in the calculation was adjusted. For someone with a $500,000 IRA, that can mean a few $100s of difference in your required withdrawal, which then becomes taxable income whether you wanted it or not. It might sound small, but for retirees who are carefully balancing their income to stay under a Medicare premium threshold or under the line where Social Security becomes more heavily taxed, even a few $100s of extra forced income can tip the scale in the wrong direction. Picture someone who has spent years staying just under the first Medicare IRMAA tier on purpose. A small bump in their required withdrawal could be the exact amount that pushes them over that line and into a higher premium bracket for the entire following year. Rule number 4 is one that caught a lot of financial advisors off guard, and it specifically targets higher income workers who are still contributing to retirement accounts in the years right before retirement. Starting in 2026, if you earned more than $150,000 in wages the previous year, any catch-up contributions you make to your 401k, 403b, or similar employer plan must go into a Roth account. That means after-tax dollars, not the pre-tax contributions many people have relied on for decades to lower their taxable income in their final working years. This applies to the standard catch-up contribution for people 50 and older, and it also applies to the enhanced catch-up contribution for people age 60 to 63. If you fall into that income bracket and you are planning to shelter extra income through catch up contributions the old way, that strategy just changed under your feet, and you will not get the immediate tax deduction you may have been counting on this year. The silver lining is that Roth dollars grow tax free and will not count toward future RMDs from that account. So, this is not entirely bad news, it just changes the timing of when you pay tax. Now, here is rule number 5, and this is the one we promised earlier because while everyone is focused on the Roth requirement in Rule 4, almost nobody is talking about how much bigger the actual contribution limits got for 2026. The 401k employee contribution limit increased to $24,500. The IRA contribution limit increased to $7,500, with an additional catch up amount for people 50 and older, bringing that even higher. And if you are between the ages of 60 and 63, there is a special enhanced catch-up contribution that remains at $11,250, which is significantly higher than the standard catch-up amount available to everyone else over 50. When you add that enhanced catch-up on top of the regular 401k limit, someone in that 60 to 63 age window could potentially put away $35,750 into their workplace retirement plan in 2026 alone. And if you are married, your spouse can do the same thing in their own accounts, which means a couple in that 60 to 63 window could be sheltering well over $70,000 combined in a single year. That is one of the largest contribution windows the IRS has ever allowed, and it exists for a very specific 4-year stretch of someone's life. If you are in that age range and you have the cash flow to take advantage of it, this could be the single biggest opportunity to catch up on retirement savings before RMDs even become part of the conversation. So, to recap quickly, the IRS raised your standard deduction and your senior deduction, added a brand new temporary bonus deduction for people over 65, quietly adjusted the RMD calculation tables, forced high earners into Roth catch up contributions, and opened up one of the largest retirement contribution windows ever for people age 60 to 63. Some of these rules can save you real money if you plan around them, and some of them can cost you money if you ignore them and keep filing the way you always have. None of these numbers are guesses. They come directly from IRS guidance for 2026, so it is worth checking your own filing status and income against them before you assume last year's numbers still apply. The retirees who come out ahead this year are not the ones with the most money. They're the ones who actually know these 5 rules exist before they sit down to file. If you are 65 or older or you are getting close to that age, drop a comment with your age and which of these 5 rules surprised you the most. And if this helped clear things up, subscribe so you do not miss the next one, because the IRS is not done making changes for 2026.